Well, good afternoon, everybody, and welcome to the latest webinar for Australian Catholic Super. Today, we'll be joined by Phil Johnson, who's one of our financial planners, and also in the background, we'll have with us Justin Colley. And Justin will be monitoring the chat box and the Q&A section. So for those of you that do have questions throughout the session today, please feel free to just make a note of them, and we'll circle back to Justin at the later part of the webinar. And if we haven't answered those questions already, we'll make sure we address them. Also too, if there are questions that need further explanation or a more detailed discussion, we will have your details, and we'll make sure we do a follow-up call tomorrow at some stage. Additionally, just so you know, this session is being recorded and will be available on YouTube from tomorrow. So if there is anything that perhaps you miss or you want to see again, it will be available to review. I'm sorry, Justin, I'm having trouble advancing and moving to the next slide. There we go. Firstly, I'd like to acknowledge the traditional custodians of the land on which I work and live, and recognise their continuing connection to land, water and community. I pay respects to elders past, present and emerging. Also today, I should point out, this is general advice. We encourage everybody to read the PDS and to seek advice when making decisions with regard to their superannuation. And for those that do want to make decisions on their superannuation, we will talk later about how to get that advice if you so need it. First, we'll talk a little bit about retirement goals, and typically the discussions planners would have with people that are in their often mid to late 50s and even early 60s and approaching retirement. They'll often want to talk about their retirement goals, which traditionally involve travel, although it's fair to say that's changed a little bit over the last couple of years given the restrictions and the difficulty. Likewise, you'll see we've got a cruise ship there, and people's view on cruising has changed noticeably over the past few years. Family time is just as important as ever. But going out, enjoying themselves, whether it be, the theatre, camping, shows, etc., and even gardening at home, all those things are vitally important for people when they consider their retirement. But what we do encourage people to do is give some thought to what you're going to do post-work, and absolutely discuss it with your spouse, and make sure that you are like-minded on some of the key fundamentals. So if one of you wishes to buy a caravan and travel Australia and the other one does not at all, then it could obviously create some conflict. So try and be fairly clear on not just the monetary goals, but what those retirement goals are. One of the questions we get most is, how much am I going to need when I retire? Which is a difficult question. However, the ASFA, or the Australian Superannuation Fund Association, have put together a guide. Now, this is a guide only, because to come up with numbers that suit everybody throughout the entire country is nigh on impossible, but it gives you a good sense of what's deemed to be modest and what's deemed to be comfortable. And as you can see there, for a couple, a modest retirement combined income is just under 42,000, and for a couple is just under 65. And that obviously includes all sources of income. So it'll be your superannuation in drawdown phase. It will also likely be an age pension of some description, and whatever other sources of income you've got. So as we say, it's not the be all and end all, but it is a very, very good guide. And for those that are interested in a bit of the methodology behind the guide, you can see there on screen what's deemed comfortable and what's deemed modest. And there's obviously subjectivity around these definitions, But if you want to download the report, you can see the link down the bottom there. It's available to all, and it is, if you've never given thought to how much you're going to need and what categories people spend in, then this can be very, very helpful, and we'd encourage you to all have a look at it. When we talk about your financial situation, and particularly when you're heading into retirement, it's important to consider far more than just your superannuation fund. Obviously, we're talking about all your assets here, because they're all able to combine in some way to finance a retirement. So we're talking about cash, we're talking about shares, we could be talking about properties and investment properties. We could also be talking about the family home. And the reason I mention the family home is because of a strategy known as Downsizer. And we will speak a little bit more about that as we move through the session, and obviously superannuation. I might go to Phil now, if I can, Phil, just to talk about the benefits of saving with superannuation and the various concessional tax rates you receive at different stages. So Phil, if I could pass to you.
Thank you, Wayne, and good afternoon, everybody. Yeah, now this slide's just trying to explain to people that superannuation is a very tax-effective way of saving money and investing money. So what it's trying to say is that superannuation, when you're adding money into it, which is generally when you're working, the money is put into the super fund. And then once it's in the fund only pays 15% tax or up to 15% tax on the earnings of the fund. Now, if I just quickly go to the right-hand side of the screen, you can actually see it talks about account-based pensions there. We're going to talk a bit more about those in a minute, but at this stage, I just want you to know that when you start to draw down on your super, you may well have one of these account-based pensions that's mentioned here, and the earnings on the account-based pensions are actually zero. So there's no tax on the earnings. So I think the basic message we're trying to give to you here is that superannuation is very low tax. If you compare that, generally speaking, to the marginal tax rate that people will pay on earnings that they have outside of super, then it will generally be much higher than 15%, and certainly it's very hard to beat paying no tax in the retirement phase of super, which is the account-based pension.
Thanks, Phil. And also, Phil, if you could speak about the various age brackets and the importance of these at the moment.
Yeah, okay. So there's a couple of points here. What this slide is just trying to show to people is that there's some very significant age in superannuation, both in terms of access to your super and in terms of tax. So in terms of accessing your super, I think most people sort of generally know the idea that the government really doesn't want you to access your super, generally speaking, until you've retired. But more specifically, in order to be able to access your super, you generally speaking have to have met what's called a condition of release, which is a word used to describe reasons why you can access your super or why the government will let you access. In order to be able to access your super, if you have retired and have met what's called your preservation age, which is different depending on when you were born. But if your preservation age, if you have met it between 58 and 59, is possible at the moment, then if you've retired, you can actually access your super. I should point out, however, that there may be tax consequences of accessing your super before 60, which sort of brings me onto the middle circle in our graph, which is that if you've accessed your super after turning 60, then there's no tax on the withdrawals from the super, generally speaking. In addition to that, you don't actually necessarily have to retire to be able to access your super. You can potentially access your super just by virtue of the fact that you've left a job. So you might change jobs change careers or employers. If you've done that, then you can potentially access your super after 60. And then age over 65, still all the money that you take out of your super will be tax-free, but you can, in theory, access your super without actually having to retire. So at 65, you can still continue with your current job if you're enjoying it, and still have the benefit of being able to get some access if you want it.
Thanks, Phil. And one of the pleasing things we've experienced lately is a rise in what's called the superannuation guarantee rate. You may not have noticed it, but previous financial year, the mandated amount that went in was 10%, as you can see on that chart. However, from the 1st of July of this year, it's been raised to 10.5. And you can see in the coming years, it continues to rise all the way through to 12%. So what this is designed to do is just ensure that there's more money going into your super. So it should, assuming normal earnings, result in a healthier balance at the end. So important reform, and it shows how serious the government takes superannuation and the importance of it to fund that stage when you leave the workforce. If we have a look at the income tax rates, this helps us to explain why people salary sacrifice. And we've got an example coming up, and I'll throw to Phil to walk through the example. But just to show you what the marginal tax rates are, you can see them on your right. Most people are paying 32.5% tax. By salary sacrificing, in short, you're paying a 15% contributions tax rather than that marginal tax rate of 32. So it's essentially the difference between 15% of the whereby the money goes into super, or that marginal rate where the money would go to your bank account through normal salary and wages. That is the benefit of a salary sacrifice arrangement. And as I move to this example, Phil, would you be good enough just to walk us through this example and just to highlight that difference?
Yeah, sure. Thanks, Wayne. So just a little example, as Wayne said, just to try to demonstrate the tax benefit of salary sacrificing some of your pre-tax salary into superannuation. And you can see in the little table, there is it's an example of somebody who's earning $100,000 per year, which and we've broken it down into a fortnightly payment. There's three columns, but the two columns are from the the column in the middle and the column on the right are the ones I'm comparing. So you can see the person there is receiving $100,000 a year, or $3,846 per fortnight. And if they don't make any contributions, nothing changes in terms of salary sacrifice, but the person on the right is going to salary sacrifice 5% of their salary, which is $192. So the effect of that, if you follow the table, the rows down the page, the effect of that is it reduces your taxable income, and your taxable income is how much is the basis of how much tax you're actually going to pay. So net effect is that you salary sacrifice, and you might notice in the take-home pay that your take-home pay has fallen slightly, so that you do receive a little bit less pay. However, your tax liability reduces, and you actually save, in this particular example, $66 per fortnight, which equates to $1,716 per year, and over a 10-year period turns out to be $17,160. So I think the other point that's being tried to demonstrate here is that $66 a fortnight doesn't necessarily sound like a lot of money, but like a lot of things in superannuation, where you're talking about a long-term investment, you continue doing that and adding to your savings and making these tax savings over a long period of time, these savings actually become significant.
Thanks, Phil. And when we talk about contributions to super, I just want to talk about for a moment the concessional contributions. Now, these are contributions that are often called pre-tax contributions. So this is money that, instead of going to your bank account, it goes directly to superannuation. So we're talking about employer contributions, the superannuation guarantee amount, which we just looked at 10.5%, any additional salary sacrifice, which Phil just took us through the example, any additional contributions from the employer, and any personal contributions which we later claim a tax deduction for. And because all of these types of concessional contributions are favourably taxed in the sense that they're taxed at 15%, there is a limit on how much you can put in a single year. And as you can see there, it's 27,500 per financial year. There is, however, and for those that are interested, we can provide more information. There is, however, an allowance to use up unused amounts of that cap from previous years. And we do have information and fact sheets on that for those that wish to get more detail. But that's what we are meaning when we talk about concessional contributions or pre-tax contributions. If we talk about non-concessional contributions, now we're talking about post-tax contributions. So this is where you've earned a certain amount of money, the money has gone to your bank account, so you've paid your marginal tax rate on this money. And as we saw, the average marginal tax rate for most people is 32.5%. You now have a much more generous allowance of how much you can put into super. And as you can see there, it's $110,000 a year. And you can use this 3-year provision, which allows you to put in 3 years worth of contributions in one go, on the assumption you're not going to put anything in year 2 and year 3. So you're essentially using up a 3-year allowance in a single year. And as you can see there, once you turn 75 and over, then there's no further contributions. The idea being that at that age, it's a good time to start drawing back on your super or enjoying the money you've got. But yeah, there's no, it's deemed that there's no need to be contributing more after-tax money into superannuation at that age. Other ways you can contribute, and I mentioned this one earlier, it's the Downsizer, a relatively recent innovation which allows people of age 60 plus to sell the owner-occupied dwelling and put a sizable amount of money into superannuation, and it isn't counted towards those caps we just looked at. So, and it doesn't matter what house you sell or dwelling you sell and move to, as long as there's excess money left over, that's eligible to be put into superannuation. So I've had the question before, can I go from a 2-bedroom to a 3-bedroom or whatever it may be? That's not part of the criteria. It's simply a matter of, are there excess proceeds from the change of home, if you like? And if there are, then you will be eligible to put it into superannuation. There are some conditions, and we do encourage people to check the fact sheets with this. And it's probably worthwhile to get advice from someone like Phil or an advisor if you're choosing to do it, because it's a substantial step if you're going to sell the house you're living in. Spouse contributions are obviously another strategy which not as widely used as they once were, but they can be an effective way to get money into superannuation as a couple. And consolidating your super, as a rule, is a good idea. The only thing we always caution people with is understand the fund you're leaving. And by that I mean, make sure there's no benefits in that fund that you wish to hold on to and don't want to forego. And I'm thinking in particular, there may be insurances attached to a fund. So you've got to give a lot of consideration to leaving that fund, because it will effectively cease the insurance arrangements. So yeah, take a bit of a cautionary approach when you do consolidate. Understand just what you're leaving behind, if you like. When can you access your super? This is a question we often get, and Phil touched on it a little bit before in the other slide. As you can see there with the dates, there's the preservation age is moving to 60, and this will wash through in the years to come. But at this stage, you can see those born between sort of mid 62 and mid 63 are at 58, those at mid 63, mid 64 are at 59. And quite simply, those born after mid 64, your preservation age is 60. And in order to get your money, you need to meet two conditions. One is the preservation age, and one is the condition of release. And as you can see there, the condition of release, when you're under 60, is genuinely retired. But once you hit 60, it's a cessation of the current employment arrangement or genuine retirement. So fairly straightforward stuff. For most people, it's pretty straightforward stuff. They access their money once they're in their 60s. And when we talk about accessing your money, we're talking about taking a lump sum, an income stream, one or the other, or a combination of either. So for quite a few people, what they'll decide to do is when they retire, they may pay off the car, replace the car, use a small lump sum to go on holidays, perhaps, pay out any outstanding balance on the mortgage, and then with the remainder converted into an income stream. So they've got a monthly payment going into their bank account from their accumulated superannuation. And when you reach that stage, we call that an allocated pension or an account-based pension. But essentially, is all you're doing is you're taking regular income from your accumulated superannuation. I'll ask Phil to speak to this slide because this is the critical point for those moving from what we'd say the accumulation stage to the drawdown stage. So this is where people typically will want advice because they're moving out of the workforce and they're moving from putting money into super to starting to take money out of super. So Phil, if I could ask you just to walk us through this one, that'd be terrific.
Yep, sure. Thanks, Wayne. And I think we've been touching on the elements of this slide already quite a bit. So just to sort of reinforce it, when you're working, on the left-hand side, you are generally adding money into superannuation. It's called the accumulation phase. On the right-hand side, you've got the pension phase. Generally speaking, you're starting to access your super and draw down a regular income. So some of the characteristics of that super account when you're working, some of the things we've already talked about, you're contributing or your employer's contributing. You might have made a downsizer contribution even. All sorts of contributions can be made into your super account. In contrast, when you start a pension, you're no longer contributing money into a pension account, you're actually drawing money out, and you can take regular payments, but you can also take lump sums if you need it, and you can change the pension payments if you need to. There are restrictions on how much much you must take from a pension, which I think we're going to come to later. But I think that's the main concepts are this idea that one phase of super is when you're working, you're adding money in. You retire, generally speaking, you start to draw money out. The big point as well is, as I've already said, while you're working and your money's in the super account, the earnings that the fund is paying on, the tax that your fund is paying on the earnings that you make in your super account is taxed at up to 15% tax. However, in retirement, it's even better. It's actually no tax on the earnings, which is a substantial benefit.
Excellent, thanks, Phil. Another thing you would have heard a lot about and in barbecue conversation is this transition to retirement arrangement, which is very, very popular, particularly for those who have turned 60. So again, I'll ask Phil to speak to it because this is typically what he would explain to members when they are seeking advice and how they can make use of this strategy.
Thanks, Wayne. So this transition to retirement pension. So it's kind of like a third option. We've been talking about adding money into super, and we've talking about taking money out of super, or taking money out of a pension. There's also this interim position, I'll call it today, TTR, transition to retirement pension. What are the characteristics of it, and why is it potentially of interest to people? So from a tax perspective, it's the same as your super. It pays 15% tax on the earnings, which is the same as what your super fund pays already. However, the key to the transition to retirement pension, I guess, is that you can potentially start to turn or access your money by turning some of your super into a pension before you've actually retired. So you may be able to get access to some of your super before you retire. So that could open up opportunities to work part-time and things like that, because now you can actually start to draw a bit of income from your super. But the point is, you don't get full access to your super. So there are some rules around this, so the parameters are basically that you must take a minimum pension payment, which is dependent on your age, and is a percentage of your it's a percentage of the amount of money you've got in the pension. So for instance, normally a person who's, say, 60 would have to take a minimum payment of 4%. Mentions there on the slide, because of the pandemic, that's actually currently reduced to 2%. However, you cannot draw more than 10% out of the transition to retirement pension in a single year. So if you've got a pension, say, with $100,000, you wouldn't be able to take an income of more than $10,000 per year. Final point down on the bottom of the slide is, once again, as I think I've already mentioned, if you draw money out of a pension and you are already over 60, then that pension payment will be tax-free to you.
Thanks, Phil. And as mentioned, the transition to retirement is exactly what it says. It assumes you're working part-time, so you're not necessarily working full-time, but you could be, but you're working part-time, so you're transitioning to retirement. However, when we talk about the allocated pension, we're typically talking about now someone who has retired. So they've finished working, they're not accumulating superannuation anymore. They're actually looking at drawing down their superannuation. So again, a concept that Phil would regularly explain to members when they come and see him. So Phil, would you be good enough just to walk us through some of the features of the allocated pension, please?
Sure, no problem, Wayne. So the allocated pension, we've mentioned a couple of times now, is actually a tax-free investment. There is no tax on the earnings. So super, reminding everybody, super pays 15% tax on earnings. If you can move your money into an allocated pension, then there's no tax on earnings. So there's an immediate benefit in terms of the amount of money that you may have in your super, because your fund might have to pay. Your fund has the potential to pay less tax if you can move your money into a pension. There's also, just like the transition to retirement pension, I actually mentioned, there's a minimum pension payment, and it's actually the same rules apply. Broadly speaking, as I said, it's based on your age is the minimum payment requirement. But unlike the transition to retirement pension, where there's a maximum amount you can take, there is no maximum. You can take what you like, bearing in mind, of course, if you draw too much money too fast, you can run out of money. So it's nice to have the freedom, but it doesn't necessarily mean it certainly doesn't mean that you should just go for broke and spend it all in one hit. That's for sure. The pension payments, same as transition to retirement pension. If you're over 60, they will be tax-free. If you can start a transition to retirement pension before 60, which some people can if they've met their preservation age, then or met a condition of release is probably a better way of saying. If you can start a pension before 60, it is taxable, but it does get a tax rebate. It has still got some tax advantages, but it could be taxable. Yeah, and the other thing is, as it says down the last item on the slide, is that with an allocated pension, you actually can take a lump sum as well. So you take a regular payment, but quite often what happens with clients is, I don't know, they might need to buy a new car, and they might need to take a lump sum. So that in addition to taking their regular payment, they can also draw a lump sum if they require it.
Thanks, Phil. The other question that often comes up when people enter this stage is age pension, and what is the eligibility and what's the assessment criteria. So we'll walk through that. So the things to consider are age, residency status, the assets test, the income test, and what does the age pension actually pay in terms of what's its maximum and when does it cut out. So we'll walk through that. Just to remind people though, the eligibility age for age pension has been moving up. And as you can see there, for those born on or after the 1st of January 1957, it will be 67 for everybody thereafter. So there are some that still fall into that 66 and a half age where they can access the age pension, but for most, it will very, very soon be 67, and soon it will only be 67 years old. So if we have a look at the assets test, and we'll start with the assets test because most people are impacted by the assets test. And I should also state that the assessment, or the government will use the test that minimises the age pension payment to you. So they don't use the assessment that favours the highest payment to you. They take the opposite approach, if you like. So think of them as guardians of public money, and they're trying to minimise the age pension payment. So for the assets test, if we look at single people, whether they're homeowners or non-homeowners, you can see the purple section. So let me take a single homeowner. A single homeowner could hold up to $270,000 in assets and receive full pension under the assets test. A non-homeowner, can have up to 487,000. And you can see the blue section is where you would receive part age pension. And once you enter the amber zone, that's when you will no longer be eligible to receive any pension. And the logic being, for a single, once you approach that 600,000 mark, and for a single non-homeowner, once you reach 816,000 odd, the view is, rightly or wrongly, you no longer need the government-funded age pension payment. If we have a look at the more common couple arrangement, if we look at a couple homeowner, which is often the typical situation, you can see there the couple could have assets of up to 405,000 combined and receive full pension. The blue section, as you can see, is where they would receive part pension. But once their assets, including superannuation, exceeded 901,500, they would be excluded from age pension. They would simply no longer qualify. And again, if you have a look at the non-homeowner, the allowances are more generous because they've obviously got a fund somewhere to live. So there's a reasonableness test, if you like, that applies on these assessments. And if we have a look at the income test, you can see there, and this is income per fortnight, you can see there that a single person can have up to $180 per fortnight. A couple can have up to $320 per fortnight in order to receive full age pension. There has been a bit of discussion around, you may have noticed, around retirees earning some money, and having these amounts be a little more generous before the age pension starts to be impacted. However, that debate's probably got some way to run. But there has been some recent debate with regard to the income test, and are we punishing people and retirees for trying to contribute, if you like, and do work in the community. So the Centrelink pension rates, and I should say too, 4 out of 5 people get some form of age pension. So most people get age pension, and they may not get full age pension, but they could be similar to my parents where they get part age pension. So between their own superannuation fund and the amount they're drawing down and the age pension, they're able to have a reasonable income. So if we have a look at the maximum that would be payable under the current age pension rates, you can see there 25,600 odd for a single, and for a couple you can see combined 38,708. And you can see there that if the couple are apart due to ill health, which is increasingly common as people get older, they effectively receive the single rate. The other thing to mention, and people often have a lot of questions around the seniors card. There are some criteria around the Commonwealth seniors card. So you need to have, as you can see there, reached a certain age pension age. You've got to meet an income test, and you can see it there. Again, we talk about these tests of reasonableness. For a single person, just shy of 58,000, and for a couple, just over 92,000. And if you do meet these income requirements, then you are entitled to cheaper medicine and bulk billed doctor visits and the like. It's worth thinking of the Commonwealth seniors card as, what do the federal government control? Now, the federal government control health. So that's why that falls under the Commonwealth seniors card. Whereas the states or the territories control often the utilities and public transport. And that is why you often get a complementary card from your local jurisdiction in terms of state or territory, which will offer you discounts on public transport or lower utility bills, because they're more in the realm of state and territory governments rather than federal governments. So in terms of what's changing and what has changed for this financial year. So, and this is the first point here I want to emphasize, because this has been a change we've been wanting for a long, long time. So now people in that 67 to 74-year-old bracket will no longer have to meet a work test to make voluntary contributions and salary sacrifice contributions to super. So it was quite honestly an impediment that for those over 67 had to meet. It didn't make a lot of sense, because these are people who are wanting to contribute to super, and we were encouraging them to do so. So why would we put hurdles in the way? So mercifully, that requirement has now gone. The bring forward rule, therefore, as a result, has increased to age 75. And what we're talking about there is what we looked at before, where you could put in 3 years worth of non-concessional contributions in a single year and use up that 3-year allowance. The minimum age for the downsizer contribution, this is where you sell effectively the home you're living in order to free up capital and get it into super, has reduced from 65 to 60. So it gives people far more flexibility when they go into those early stages of retirement to boost their superannuation. And also at the other end of the spectrum, first home buyers can now use superannuation to save for a deposit. Pleasingly, the government has continued to extend the 50% reduction on the minimum drawdown requirement. Now, let me explain that. When you're in the allocated pension, there is a minimum amount you must take from that allocated pension. And what the government have done over the last few years is, due to COVID and spending patterns being heavily reduced, they've allowed this 50% reduction in the minimum. So if the minimum you needed to take out of your allocated pension, for example, was 5%, it became 2.5%. and it's continued at 2.5%. So it's continued to be half of the minimum, if that makes sense. That said, most people take modest amounts out of their super. Phil mentioned before that there were no upper limits and that you could take as much out if you wished. The vast majority of people don't. They have this real concern around what we call longevity risk and the fact that this money has to last all the way through to life expectancy. So they often do take minimum or close to minimum. Again, at the other end of the spectrum, the 450 superannuation guarantee threshold will be removed, which just means those that are earning low incomes will still receive the superannuation guarantee contribution of 10.5%. And as I mentioned earlier, it has risen to 10.5% rather than 10%. I'll refer to Phil with regard to estate planning, because this is one of the areas that, again, people coming to see him for advice, they also want to talk about not just the retirement phase, if you like, the post-retirement phase, to be polite. So Phil, if I could ask you just to touch on some really key points here on estate planning, that'd be terrific.
Yeah, sure. Thanks, Wayne. So yes, particularly, I think you're right, Wayne. Particularly when people are retiring, it is a good opportunity. If some of these documents, these important documents, haven't been put in place already, it's a very good opportunity to sort all these affairs out as part of planning for your retirement. And of course, you're talking about how you really want your assets to pass when you pass away. Most people are sort of broadly aware of the importance of having a will. Also, people should seriously consider talking to a solicitor or a legal professional about having a power of attorney or enduring power of attorney put in place, which can be very helpful at a time when you may not be able to make decisions for yourself, or it could be for a variety of reasons. Thinking about how would you like to have somebody that you feel that you can trust to help manage your affairs, essentially, in that sort of situation. Likewise, more specifically in relation to superannuation, very important to think about who you've nominated as the beneficiaries on your super. Sometimes I see people that haven't really thought about this sort of stuff a lot, but there is obviously who you decide to leave your money to is important, generally speaking, for your family quite often, and there can also be tax consequences of who you choose to name. Different types of beneficiaries pay different tax. Some pay no tax. So look, all these things are very important. We can sort of help generally with raising this issue with you. We always suggest to people that in terms of some of these legal documents, that they should also seek the services of a legal professional, such as a solicitor.
Thanks, Phil. And also, Phil, if you can just talk about how a person such as yourself, being a planner, is able to assist people around these sort of key decision times, if you like.
So, I mean, there's a list there. Some of the things we've already touched on today, some of the things that we do, but typically when we're talking to people about planning for their retirement, the biggest question they usually want answered is, can I afford to retire? And we can certainly help with our software and modeling tools, try to help answer the question about what sort of situation you're in terms of your ability to be able to have an affordable retirement. We are looking to help people to invest in a way to help them make their money last, and invest in a tax-effective way, and to help improve their any Centrelink or age pension benefit that they might be able to get, which all these things help combine to make your money last longer. And we're trying to get all your ducks basically lined up to try to make your money work as hard as it can for you. Just a couple of other little points that are on the slide as well is sometimes people think that we can only advise on superannuation, but that's not the case. We will, generally speaking, take into account your more broader financial situation than just your money in your super. And there was a slide that Wayne talked about at the beginning of the presentation about that. So we're talking about, potentially money in the bank, for instance, or it could be an investment property, could be a share portfolio, many things. They can all be taken into account as part of the advice that we give. And another thing that a lot of people aren't real sure about is that they don't think that we can provide advice to someone, to a spouse, for instance, who's not a member of Australian Catholic Super. But in fact, we generally can. And as a matter of fact, we generally encourage people, if their finances work in terms of a couple, it's usually much better to speak to people as a couple.
Thank you, Phil. And in terms of general information, this is where people such as myself and the call center and the like, and the website and the app is able to provide loads of information for you to do a little bit of research yourself. And we do encourage everyone to use those sources that are available to you. Please don't have any unanswered questions when it comes to your superannuation, because the information's all there and it's very easy to access. And if any of it isn't clear, that's absolutely what we're here to assist with. And as Phil mentioned when he's talking about how planners are able to assist, there are a number of offerings. One's known as the over-the-phone limited advice service. Can be in person, but it's often over the phone. And this is limited to superannuation and those aspects of superannuation. So it could be the investment, it could be the insurance aspects, or it could be a transition to retirement. But it is limited to the fund, if you like. Whereas when we talk about a far more holistic offering, we're talking about comprehensive advice. And this is typically where financial planners such as Phil are able to really shine and really add value to your situation, because they can, as Phil mentioned, consider things beyond your superannuation. Your entire circumstances can be considered, if you like. We do encourage people strongly to use the member portal. If you haven't, please register and please do access it, because it can show you, as you can see there, at a glance what you've got. It can provide all the details you need in terms of contributions you've made and what contributions, what's left in your contribution cap, I should say. What insurances you have, and if you wish to make any changes to any of the arrangements you've got, you can certainly do it via the portal. As mentioned, the key things people use the portal for: to make a contribution, to obviously see their balances, to change investment options if they wish, to have a look at their insurances, to nominate a non-binding beneficiary, and many other of those other type of transactions. So what can you do right now? Use the member portal. Also use the phone app if you would. Speak to your local RM, which could be myself, but it may be someone different, but it'll be someone in your local area. Perhaps talk to the call center or talk directly to the financial planning team, who will be able to assist in all sorts of ways. We're always available, as you can see there, on the 1300. Our email, you're more than welcome to use, and of course a lot of the information we have is always available on the website. So we're at that point where I'm going to circle back to Justin just to see what questions have come in. We've covered a lot over the last 50 or so minutes, so it's natural enough that there may be areas that we need to further explain. So Justin, could you let us know if there are any questions?
Yeah, thanks, Wayne and Phil. It's been a very informative session today, so thank you. There's been a couple of questions that have come through, but a few of them are of a personal nature. So as Wayne mentioned earlier, your local regional manager will reach out to you in the next 24 hours or so and help you answer that. But the questions that we can ask, the first one is I'll go to Phil, and it is, what is the cost for comprehensive advice for members?
Oh, okay. So look, every case is costed based on the amount of work involved. You know, generally speaking, the cost will be, I mean, it ranges anywhere probably between, generally speaking, it wouldn't be less than, I don't know, $1,500. It could be up to $5,000-$6,000, but on average, Australian Catholic Super, probably about, I don't know, probably about $3,000-$3,500. But as I say, depends on the job itself.
Thanks, Phil. And whilst you're there as well, Phil, another member has asked, what is the minimum withdrawal or minimum percentage withdrawal from an allocated pension?
Yeah, so what I was saying in the presentation was that it depends on your age. So for instance, if you are under 65, then the normal minimum payment is 4% of your account balance. If you are over 65 and under 75, for instance, it's the normal amount is 5% of your account balance. Now, the little tricky, complicating factor is that because of the pandemic, the government has at the moment halved the minimum payments. So in my examples I just gave, the current minimum payment for a person under 65 is 2%, being half of 4, and correspondingly for a person between 65 and 75, it's 2.5%.
Thanks, Phil. We've also got a couple of questions relating about consolidating super. The general one is, how do I go about combining other superannuation funds into my Catholic super fund? And there's one a bit more detailed, which I'll touch on after. Did you want to answer that one first, Wayne?
Yeah, there's a couple of ways you can consolidate your super. One is use the portal. Two, you can also go to your MyGov, and under MyGov, the ATO also provide a facility whereby you can consolidate your super as well. And the only thing you really need to do is let the acquiring fund know where your other money is. So for example, let's say you're wanting to shift money to Australian Catholic Super, and it happens to be with ING, for example. You would just inform Australian Catholic Super the details of your ING fund, and effectively they go and get the money on your behalf. So no fund can refuse, if you like, to send the money to, in this instance, Australian Catholic Super. There is a standardized ATO form as well, but on most occasions, people would use the acquiring funds website, if you like, and portal to key in those details, and then the fund will do, if you like, the legwork for you and just acquire those proceeds and put them into your existing holding.
Thanks, Wayne. And another member on the same theme has asked about they're searching for lost super accounts dating back to the 90s and for not properly set up or paid by a previous employee. How far does the ATO go back?
Oh, good question. As far as I know, the ATO go back a long, long way, because any what's considered lost super, which is effectively inactive super, whereby the superannuation company cannot contact you, the proceeds go to the ATO. So the easy way to check if you have any lost super is to go to the ATO website and you actually key in your tax file number, and it will do a search to see if there's any unclaimed monies that actually are yours. So yeah, don't be persuaded to pay effectively a finder, because it's actually a free service and it's very, very easy to do. You could Google up, find my lost super, and go to the ATO website, key in your tax file number, and it will deliver and show you any super that's that has been misplaced or lost because the company that holds it can no longer find you. So you've moved address or for whatever reason, and the fund has become completely inactive, if you like. Phil, is there anything else I should explain on that front? I'm just thinking you probably see more scenarios than I.
No, I don't think I have anything else to add there, Wayne. I'm not aware of any particular limit that the ATO has. So that's I don't have anything else to add.
Well, I might just add something as well. You've mentioned through the portal, the MyGov portal, and you can do it through the superannuation section there and doing a search through our portal. If you're not comfortable doing it that way, you can also call our call centre on 1300 658 776, and they can take you through a recording and record you agreeing for the fund to do a search for you on your behalf. And so we can do a search for any lost superannuation for you as well by calling our call centre. I noticed a member has said that they have had were unsuccessful in trying to do that. So maybe call the or through online, sorry. So maybe try to call the fund and we can assist you online there as well, because it is case sensitive and alike. So they may be when you do enter those things. So our call centre may be able to help you there. So I'm just watching my screen. A few more are coming in. And I'll answer the next one, and it is, will a recording of today's webinar be made available? The short answer is yes. So usually these are put on our fund's website to a link to our YouTube page within 24 to 48 hours after the completion of this webinar. But also this webinar has been streamed live onto Facebook. So this is also on our Facebook page as well. So the post is saved there, so you can go back at any time through Facebook and watch a recording of this session as well. So I'm just scrolling quickly through here. What are the benefits? I'll go to Phil on this one. Phil, what are the benefits for depositing money into your spouse's super?
Oh, okay. So we're referring to the spouse contribution, which we did mention in the presentation. So look, the maximum benefit you can get is a tax rebate of $540 if you make a contribution of $3,000 into your spouse's super account. So the maximum you can get is $540 discount on your tax bill, essentially, by making a $3,000 contribution. What the government does there, but is that it also depends on how much income your spouse earns. So I think if your spouse earns less than $37,000 and you put in $3,000 contribution to your spouse's account, then you'd get $540. But over $37,000 of income, it starts cutting out. And by the time your spouse's income gets to $40,000, there's no benefit.
Thanks, Phil. I'm conscious of time. We've still got a few questions coming in. I might just keep it now to the last two. And the other questions we haven't got to, as Wayne has said earlier, your local regional manager will get back to you. So the next question is, and it comes back to our rolling over, our consolidation. How do I find out if there's a cost from the opposing fund to transfer to Australian Catholic Super? I'm happy to answer that one. A few years ago, the government changed the rules and funds can no longer charge you an exit fee or a benefit payment fee there. So that should be all part of your normal weekly administration fees. So there should be no cost for you to transfer from your existing fund to Australian Catholic Super. The next question is, what is the maximum percentage of my wage that I can salary sacrifice? Who wants to answer that one?
I'll answer it if you want me to.
Yeah, thanks, Phil.
Well, it's not. Look. First of all, I probably should say there might be some specific rules that your employer has. So I'm only going to answer it in terms of what the general case is, which is it's not really so much a percentage based. There are limits on how much money you can contribute as a non-concessional contribution into super, and salary sacrifice is a form of concessional contribution. So I think Wayne mentioned it earlier in the presentation, that the concessional contribution limit is $27,500, and your salary sacrifice forms part of that limit, but so too, I want to make a special note, so does your employer contribution. So the superannuation guarantee goes towards that $27,500 as well. So it's not, I don't think the question is really so much about what percentage, it's what is the amount of money that you can do that is going to keep you under the $27,500 limit.
Great, thanks, Phil. I know I said that was going to probably be the last question, but there's one that's coming which I actually quite like, so I'm going to throw it back to you. I'm sorry. What are the complexities of a 5-year age gap with a partner who is able to retire? Is it best to combine super accounts? So I guess they're probably looking for one of the partners not to have their super, so I guess, exposed to the assets test, Phil.
I think that's the way it's. That's how I was going to answer it too, Justin. So it was five years age difference, wasn't it? Yeah. So I mean, again, have to give a very broad answer, and you've kind of probably already stolen my thunder. I think no. I was just going to say, I think the thing that's coming to mind that I think is very valuable for people to know is that if one partner is below the age pension age, as a result of the age difference, then that person's assets held in the super account are not actually assessed by Centrelink for the age pension. So, you know, for example, I don't know, say one member of the couple is over 67 and is eligible for the age pension. If the younger member of the couple is, say, 62, there you go, 5 years, then that person is not eligible for the age pension because they're not old enough, and their super account, so say they have $200,000 in their super account, it's not accessible by Centrelink. So it opens up a whole range of strategies about, from a financial planning point of view, about where is the best place for the superannuation monies to be held. I think that's, in a general sense, I think that's kind of giving people the concept of what we're talking about without obviously being able to go specific into detail.
Thanks, Phil and Wayne. I'll head back to Wayne now to wrap things up. Thank you.
Well, thank you to both Phil, and thank you to you, Justin, for running through those questions. And thank you to everyone for attending today. Hopefully that was useful. Without wanting to sound like a broken record, let me just repeat, if you do have any queries, questions, concerns on anything with regard to your super, please let us know. For those that ask questions today, we will reach out to you. And just repeating again, for those that do wish to hear and see parts of today's presentation, it will be made available on YouTube. So thanks again, and have a lovely day for the rest of it. So thank you.